Hey everyone, welcome back to Investing with Tapan, where we turn financial jargon into plain English and sprinkle a little bit of fun on your investment journey. I'm Tapan, your guide through this money maze and your financial best friend forever. Today, we are diving into the world of investment. And trust me, it's gonna be more fun than a roller coaster made up of dollar bills. But before we embark on this financial thrill, do me a solid and hit that subscribe button, like the video, and turn on the notifications. You know the drill. It's like a secret handshake in the world of savvy investors now. Alright, so now we are part of the squad. And with that, let's begin with top 5 mistakes which most beginner investors make. Spoiler alert, we've all been there, done that, and now it's time to laugh at those blunders. So let's kick in with mistake number 1. Ignoring the power of diversification. Imagine this. You are at a buffet and instead of trying a little bit of everything, you just load your plate with spaghettis. Good if you're a spaghetti enthusiast, but what if they run out of sauce? Disaster, right? Investing is just like a buffet. You have a variety of options, but if you just load up on one, it's going to leave you with a bland financial feast. So diversification is a buffet for investments. You can invest in variety of assets such as stocks, bonds, GICs, mutual funds, hedge funds, private equity, gold, silver, real estate, and whatnot. So if one dish or investment is not doing so hot, the others can pick up the slack. Financial diversity at its best. So now, when thinking about investing, think of a buffet and not just a monotonous meal. Now let me break it down even further for you. Let's say you invest in a company which manufactures pogo sticks. Great if pogo sticks are the next big thing, but what if people prefer unicycles? See the problem? That's a very tricky situation. Diversification helps you riding up the ups and downs of the market without having a financial faceplant. So next time, when you are tempted to put all your eggs in the same basket, remember the buffet principle. Spread the risk, diversify your investments, and make sure that your meal is for a king, not just a spaghetti enthusiast. Time in the market beats timing the market. That brings us on to the mistake number 2, trying to time the market. It's like trying to catch a shooting star. In theory, it sounds cool, but you might just end up missing the show. Trying to time the market is like trying to predict weather without any advanced equipments. Sure, you might get it right occasionally, but most of the times, you'll just end up getting soaked in rain without having an umbrella. The market is like a roller coaster. It has its ups and downs and loops and turns. Trying to time when it's going to shoot for the moon or plummet back to the earth is a game even the pros struggle with. Now don't get me wrong. I know it's fun to think that you can beat the market and you can accurately predict what's going to happen. But in reality, it's more like hold on tight and enjoy the ride situation. If you're constantly jumping in and out of investments, then you are not an investor. You are a market acrobat. And unless you've got a cape and superpowers, that's a risky business. So let's ditch this crystal ball of accurately predicting the market and just hold on to good securities for a long term, because that gives a much better result than trying to time the market. Talking about timing the market, if you want to know why it yields a better result, check out this video somewhere on the top which talks about that. Just don't try to be a market psychic, be a patient investor and win long term. Moving on to mistake number 3 is emotional investing. Picture this. You are at an amusement park and the roller coaster is about to take a heart-stopping plunge. Exciting, right? Now imagine if your investment strategy felt the same, but with your life savings. Not so exciting anymore, right? Emotions are the unexpected twists and turns of your investment journey. One day you will be riding high on euphoria and on the other day, your face will be planted in the ground. It's not fun to see your investments drop down so much in value. Trying to invest solely based on your emotions is like navigating through a roller coaster, but blindfolded. Yeah, that's a good story for a horror movie, but in real life, not so much. I have a friend. Let's call him Dave. Dave has a weird connection with his TFSA account. He checks his account all the time. Whether we are going outside to eat, whether we are going for a movie, whether we are at an amusement park, whether we are doing absolutely nothing. He would always check his TFSA, even when the markets are closed. So naturally, when the markets go up, Dave is on a 7th sky. He is on top of the world. But when the markets are down, he would panic. And most of the times, he would end up buying high and selling low, which, a pro tip, is not a good idea. The real lesson here is, do not let emotions get the better of you. I know it's easier said than done, and I've been there. But the best part about that is, you can actually learn how to control your mind. Sometimes this emotional investing is not always emotional. You might think you have a clue of what's going on and what might happen in the future, but that's not always how it works. Number 4, overlooking fees and investment expenses, or as I like to call it, the Bermuda Triangle for investment, because here your money disappears right in front of your eyes and you wouldn't even notice. See, many of us, when we first start investing, we have that end goal in our mind. Whether that end goal is I want to have $100,000 in next 10 years, or whether it be I want to have $1 million portfolio by 20 years. And that's nice. That's a good thing to have. You have a good vision, but do not focus too much on that mountain up high that you forget to look at the puddle in front of you. Many brokers would charge you fees and commissions when you buy and sell a stock, and sometimes even when you buy and sell an ETF, which is not good for your portfolio. Of course, for the brokers it's the best thing ever. They are making a lot of money off you, and it might seem like not a lot of commissions when you first start. It does add up. So let's say even if your financial advisor is charging you 1% as an AUM stands for assets under management, and how much money they're managing for you. Never hire a financial advisor who charges a percentage of your AUM, and instead just hire someone who is a fee-only advisor. Even when you are deciding which brokerage to go for, I strongly suggest looking for one which charges you very less commission for buying and selling stocks or securities or assets, or just try to look for one that does not charge you any money. For example, Wealthsimple. Wealthsimple will not charge you any commissions to buy or sell a stock. But again, more on Wealthsimple in one of the future videos. Not sponsored, by the way. Number 5, not doing enough research. Grab your research gear to navigate through this financial jungle, because without that, succeeding is just as impossible as trying to find a needle from a haystack blindfolded. When I say do research, I mean do research about everything. Starting from the basics. What should I invest in? Should I invest in stocks, bonds, ETFs, mutual funds, hedge funds, private equity, gold, silver, real estate, insurance? What do I want to invest in? Once you figured out what you want to invest in, learn more about that. Stocks. Okay, what kind of stocks do you want to invest? Dividend stocks, blue chip stocks, small cap, mid cap, large cap, GICs. What kind of GICs? Cashable, redeemable, non-redeemable, market linked GICs, interest rate linked GICs. What kind of GICs do you want to invest for? Do research about everything. And once you start doing this research about particular company, let's say you have decided to buy a large cap tech company, maybe Apple or Google or Microsoft, 9 times out of 10 when you're studying these companies, there, what do they do, how do they earn money, what's their capital structure like, how much debt they have, how much cash they have, what's the growth potential of the company, are the products they're selling good, bad, will their sales go up, their sales go down, will their profit margin increase? When you start doing all of this research, and when you start thinking like a business owner, 9 times out of 10 most companies you just don't want to buy. Well, it's not because they are particularly bad companies, but it will be because either you don't even understand them, or it will be because they are too overvalued, or it will be because you don't see any potential or any place for that company in your personal portfolio. Like for example, if you are an ETF investor, you will not be buying Tesla. Make sense? Knowledge is power, my friends. And the power to conquer the financial seas is just a click away. Hit that subscribe button like it owes you some money. Smash that like button as if it were a piñata, and ring that notification bell as if it were your own personal financial alarm clock. Oh, and your financial journey does not end here. Let me know in the comment section below about your best financial adventures, or sometimes when you have messed up big time. Share your tale and let's make this comment section fun. Remember, my friends, the more we learn about money from each other, the wealthier we become.